Welcome to TDAM Talks and our mid-year market outlook series. Today, we are diving into the world of fixed income. From steepening yield curves, resilient bond prices, and cooling inflation, we're going to take a look at fixed income markets. We're going to look at what's happened the first half of the year and what might be ahead for the last 6 months. Please join me in welcoming Michael Augustine and Lauren Bellai to the podcast today. Welcome.
Oh, great to be here, Ingrid.
Okay, so we've done a couple of these so far, and as we go, we'd like to talk a little bit about what's happened in the first half of the year, and then maybe what we're going to look forward to. So maybe, Michael, break it down for us. What's the first half of the year look like?
Yeah, no, it's interesting because I know we were talking the other day, and we were talking about the fact that, if you fell asleep January 1st and you woke up now, you could be excused for thinking that nothing actually happened, right? Because markets seem a lot like they did in January. But I do think it is worthwhile stepping back and seeing what actually happened. So maybe the first thing I talk about is returns. So if I think about our wheelhouse, which is Canadian credit, Canadian corporate bonds in the last year have returned over 6.5%. Now, if you go down the quality spectrum, you think about high yield, we've had returns over the last year about 9.2%, right? Like these are good yields. And then if you think about year to date so far, we're getting coupon-like returns. So if you annualize those, we're looking at about 3.5%, 4%. So if I think about fixed income, it's resumed its role, portfolio diversifier, but at the same time, it's also providing income. And those income levels are at the highest level in about 15 years, so quite attractive. I sort of joke that nothing's really happened, but a lot's happened. Like if you think back to January, right? In Canada, we had mortgage interest or mortgage rule changes. We also had immigration policy changes. We got rid of the carbon tax. There was a lot of different policies, and then there's a federal election, right? So a lot really happened in Canada. And from our perspective, we're also watching sort of the table being set in the US, right? And I like the table metaphor because really there's 4 legs, right? We had trade policy, we had taxes, we have regulation, and we have immigration. And I think one of the things that's interesting looking back is maybe the staging of policies. I think we're quite bullish when we thought about tax cuts and regulatory changes, but we got tariffs first. And in hindsight, it's probably understandable why you'd start with tariffs. But I think that was one of the things that sort of threw us for a bit of a loop at the beginning of the year. Now, sort of translating this all back to bond markets and rates, we started the year, we were talking about a soft landing, inflation was coming down gently. And, we had 7 rate cuts in Canada and we had 4 in the US. So we were sort of on track to have that soft landing. And then we got sort of the strategic uncertainty from the US, right? The best analogy I've heard, and it sort of resonates with me, is I think about being in the mall with 2 young toddlers. And at the same time, they both go running in different directions, right? And that's kind of the dilemma the central bank's faced with. Which one do you chase? Do you chase inflation? Do you chase slow growth and maybe weakening labor markets? Or do you sort of stay still, right? I'm super happy to have Lauren with me today. I'm sort of going to skip over the analogies with children for a bit, but
Thank you.
Lauren's portfolio manager on our active fixed income team, and I know her and team have been doing a lot of thinking around inflation, fiscal policy, monetary policy, and what things look across the provinces in Canada. So Lauren.
Great, thanks. So I think, to kind of use your thoughts about what's happened, where do we start the year and where have we ended up? So from the beginning of the year, I would say net, we've had lower but still resilient growth and higher inflation or stickier inflation than we would have expected. So when we think about inflation, core inflation metrics in Canada and the US are around 3%. So that's just above where central banks are targeting at 2%. So there really isn't a rush to be cutting here. When we think about trade policy, which is, use the analogy of toddlers, which one should you chase after? The central banks aren't chasing after anything. Growth is where it needs to be. It's by their side. Inflation is still kind of by their other side. So they can stay still in the middle. And that's what we've seen with the Fed on hold since the beginning of the year and the Bank of Canada on hold since the second quarter. As we look ahead, again, they're not in a rush to chase after anything because there's nothing to run after. If anything, they're just tripping over their shoes at this point. So what we should expect from the going forward is to take a bit of a, patient approach similar to what they took in the first half, and they'll just be watching data and seeing how it evolves. When we think about trade policy and how that, plays out in the economy, central banks really aren't the ones that are equipped with the right tools. It's the federal government or fiscal, the government spending generally, whether that's federal, provincial, or municipal. So what we have seen is government spending has increased, or just government policy changes have changed, not just here in Canada, but globally. We think about Canada first, though. We had the Team Canada approach across all of the different provinces teaming up together to reduce interprovincial trade barriers, to work together to negotiate with our trade partners in the US. We've seen some of that start to play out. We're also seeing reduced barriers on infrastructure spending and approvals. And these, just thinking about interprovincial trade barriers, there's been an estimate that that's actually costs 4% of real GDP per capita right now.
Incredible
So we're
number. Yeah.
exactly, we've been growing at negative real GDP. So if we could just harness a fraction of that, that would be incredible. So really a lot of opportunity um, there. And then there's the increased defense spending as well. So we've seen defense spending in Canada at around 1.4% of GDP. That's going to rise to 2% by the end of the year. And now we've committed to 5% by 2035. So again, a lot of opportunity when we think about spending. It's in a positive and productive ways. This is actually good for the outlook for Canada going forward. I know we're still talking about the first half, but it really has played a role in how things have evolved.
It's interesting because as part of our mid-year outlook series, I've had this similar conversation with our equity teams, with our asset allocation teams, and the theme is the same. If you hadn't been watching, you wouldn't have believed what might have happened underneath the hood over the course of the year. Equity markets, are up across the board 6 to 8% right now, despite at one point in that chaos moment being down as much as 20%. Similarly in fixed income, there's been a lot. So you've laid a fairly optimistic outlook going forward. So what does that mean? Maybe break it down a little bit. Like, what is the credit outlook? What is the provincial outlook? What is the absolute sort of rate and yield curve outlook for the back half of the year?
Yeah, maybe I can start a little bit with returns and then, Lauren, get your thoughts maybe a bit more granularly. Like, when we think about fixed income returns, historically, the best predictor of returns would be current yields. So if I think about in Canada, the current yield's about 3.5 to 4%. In the US, about 100 basis points higher, 4.5 to 5%. If you go into private markets, you can add on 100 basis points. If you go down the quality spectrum into high yield, you can add about 300. So if you think about these sort of mid-high single-digit returns, this is the coupons that you'd clip going forward, and that's what we think about using the toolbox that we have, right? So those would be high level the kind of returns we'd be expecting to see.
I think when you think about, you talk about spreads, particularly credit spreads, as you mentioned in, equity markets in the beginning of the year, we saw a bit of a roller coaster. It was the same thing in spreads. And now we sit here at the tightest spreads we've seen since the beginning of the year. Now, I think it's important to note that in the first half of the year, well, we did see some credit spread widening, kind of peaking in middle of April. It was fairly well contained, and that is because of very strong corporate fundamentals, particularly in the investment grade space. So if I told you something widened by 0.3%, you'd think that's not a lot, and I'd agree with you. And sometimes in fixed income, small numbers don't mean big things, but in this case, it really wasn't a very big impact. So even though we're now sitting at the tights of the year across high yield, investment grade, provincial bonds, I think we can continue to see a environment going forward that's supportive of credit spreads, and that's for two reasons. First is the healthy corporate fundamentals, healthy balance sheets, so that provides a buffer in a even volatile macro environment. And the second part is supply versus demand. We are seeing supply that is being outstripped by demand. So when we think about supply, I'll use an example in Canada. If you just think about how much net issuance we've had it's actually been around flat since the beginning of the year when you take into consideration maturities, tenders. If you had coupons on top of that, we've actually had negative net supply in the Canadian bond market. So negative net supply, demand has been growing. We've been seeing inflows into fixed income because of these higher yields that Michael was mentioning here. So you've got more demand than supply, and those two things paired with those strong corporate fundamentals give that backdrop where you can see a stable spread environment.
So we've got an attractive yield profile. We've got a stable yield environment. We've got tools in the toolbox. What is the risk? What is the theme that maybe nobody's thinking about? Or how about some of the other headlines that are coming to the fore now? The Great Big Beautiful Bill, the interprovincial barriers coming down. What are people thinking about? Or is there any threat or risk to the scenario?
Yeah, maybe I'd start with maybe two sides of the coin. To Lauren's point on issuance, when we think about sovereigns issuing and we're thinking about the amount of debt that could be around the corner. So I think there are some concerns about long end rates being higher. Maybe the other side of the coin to that is that there's a lot of demand. So if I think about institutional investors, I think they've been quietly building quite a bit of demand for fixed income. Maybe just a couple examples. If I think about pension plans, uh, maybe two aspects: aging demographics and surplus positions. So, public pension plans 20 years ago, probably for every 8 employees that were growing their money, there's maybe one decumulating. And now, for every 8, there's about 8 decumulating. So that demand for fixed income, or that constant coupon promise, is a lot higher, and that's putting in a lot more demand for fixed income. At the same time, there's a lot more pension plans with this bull market in equities that are taking some of the risk off the table and purchasing fixed income. So you got a lot of good demand there. And then if I think about, again, maybe from a Canadian perspective, the Canadian story is pretty good internationally. And we've seen a lot of our provinces take advantage of tapping international markets. So it's taken some of the supply out of our market. Good story, provided it to international investors. But again, a floor under bond prices, or sort of a lid on how high rates can go. So yeah, maybe two sides of the story there.
And you had mentioned at one point in our discussion some of the tools that we have in the toolbox and some of the things that are unique to TD Asset Management's fixed income. Can you just add a little bit of sort of color on that?
Yeah, absolutely. So I would say, Canada's 2% of global GDP. So there's 98% of an opportunity set outside of Canada. So we're active in global securities. Looking at private markets is a great complement to public markets, where you can harness an illiquidity or a uniqueness premium on either mortgages or private debt securities. And then we like to think about the full quality spectrum. So going below triple B, cuspy credits, looking where we're best compensated in the higher yield space. We look at things on currency adjusted basis, but really it's that fulsome toolkit that allows you to be able to navigate and take advantage of the best opportunities at any point in time.
Just add there, I was talking about spreads being, at their tights. And this is really, I think, where active management plays a key role, because when everything is tight, that's really an opportunity to say, well, what's the best opportunity in that market, so that when you do have widening in credit spreads, which will happen, we think there'll be a lid on it, but it will happen at some point, that you can take advantage of those opportunities and you're not being caught off guard. So I think our credit research team, and which we deploy on our active fixed income team, really gives us another advantage that we've been looking at, and something that we're actively looking at right now.
Thank you both. The future sounds bright for the back half of 2025. And to our listeners, thank you for joining TDAM Talks again for our mid-year market outlook series. If you haven't already listened, please make sure to look for our equities and asset allocation, and stay tuned for our private markets. You can always find our podcast where you listen: Spotify, Apple, Google. Thanks, and have a great day.